A garbage company just admitted to the largest earnings fraud in American history, and almost nobody noticed, because who reads the financial filings of a trash hauler? For 5 straight years, top executives at one of the largest companies in America systematically lied about how much money they were making. When the truth came out, they'd overstated profits by $1.7 billion, and the stock crash that followed erased billions in a single day. This is the story of waste management. Waste management wasn't some obscure operation. By the 1990s, it was the largest waste collection and disposal company in the United States. Thousands of garbage trucks, hundreds of landfills, a business so unglamorous that almost nobody thought to scrutinize it closely. That was exactly the point. The company was founded and led by Dean Buntrock, who built waste management from the ground up into a corporate giant. But by the early 1990s, the waste industry hit a wall. Competition increased, pricing pressure grew, and for the first time in the company's history, revenue growth started to slow. Wall Street doesn't like slowing growth, and Buntrock, by every account, was determined not to let the market see it. So, starting in 1992, Buntrock and his top finance executives began a systematic scheme to make the numbers work anyway, not through better business, but through the accounting itself. Here's the core of how it worked. Every garbage truck, every dumpster, every piece of equipment waste management owned had to be depreciated over time, spread out as an expense across its useful life. The longer you claim an asset will last, the smaller the yearly expense you report, and the bigger your profits look on paper. So waste management's executives simply extended the useful lives of their trucks and equipment, arbitrarily, and far beyond industry norms. The standard useful life for a commercial dumpster in the industry was around 12 years. Waste management started claiming 15 to 20. They inflated the salvage values of equipment that had never had meaningful resale value in the first place, and they avoided writing down the declining value of their landfills, even as those landfills filled up and became less valuable by the day. None of this created a single extra dollar of real revenue. It just made expenses disappear on paper, quarter after quarter, year after year. But this is the part that turns it from bad accounting into fraud. Waste management's own auditor caught it. Arthur Andersen, yes, the same firm that would later go down with Enron, reviewed the numbers and flagged the depreciation issues as errors that needed to be corrected. Waste management's executives refused, and instead of walking away or forcing the correction, Andersen kept signing off on the financial statements anyway, year after year, while collecting significant additional consulting fees from the same client whose books it was supposed to be independently checking. It was a preview, almost a rehearsal, for exactly the kind of conflict of interest that would collapse Andersen for good less than 5 years later. Meanwhile, the executives at the center of it weren't just protecting the company's stock price, they were protecting their own. Buntrock, Rooney, and the other top officers received bonuses tied to the inflated earnings, and several cashed in company stock, while the fraud was still running underneath them. In one particularly brazen move, just days before the accounting problems became public, Buntrock donated a large block of waste management stock to his alma mater to fund a building in his name, locking in a personal tax deduction at the inflated share price right before that price was about to become meaningless. The scheme finally started to unravel in 1997 when the company brought in a new CEO from outside the organization. He ordered a full review of the accounting practices, and what his team found didn't match what the company had been telling investors for half a decade. In February 1998, Waste Management restated its earnings for 1992 through 1997. The company admitted its pre-tax profits had been overstated by approximately $1.7 billion. At the time, it was the largest earnings restatement in the history of corporate America. And the market's reaction wasn't gradual. When the full scope of the company's problems became clear, the stock cratered, at one point losing roughly a third of its value in a single trading day, erasing billions of dollars of shareholder wealth in hours. The SEC eventually charged Buntrock, Rooney, and the company's other top finance executives with securities fraud. They collectively paid tens of millions of dollars in penalties and disgorgement. Buntrock alone was ordered to pay nearly $20 million. None of them went to prison. Arthur Andersen was fined $7 million, the largest penalty the SEC had ever levied against an accounting firm up to that point, a record that wouldn't stand for long because Andersen was about to be involved in something much bigger. Waste Management separately settled a shareholder class action lawsuit for $457 million. At the time, the largest securities settlement in U.S. history, outside of a handful of exceptions. What makes Waste Management such an unsettling case isn't the size of the number, even though $1.7 billion was staggering for its time. It's how mundane the fraud was. There was no complex web of shell companies, no exotic financial instruments, no Ponzi scheme paying off old investors with new money. Just years of quietly stretching the useful life of a garbage truck on a spreadsheet, refusing to fix it when the auditor said so, and betting that nobody outside the company would ever look closely enough at a trash hauler to notice. For years, that bet paid off. Everything I use to make videos like this, scripts, tools, more stories, linloopsoftware.com. Tomorrow, the bank that hid its losses in a fake reinsurance company for 30 years.